welcome to this special edition of the Economy and Politics Show. I'm Otu Abase Baseko. 24 hours ago, the Central Bank of Nigeria Monetary Policy Committee arrived at key decisions. One of them was the devaluation of the Naira, and also the monetary policy rate increase from 12% to 13%. In this special edition, I'll be discussing with economist Arc Kola Ogunleye on the impact of these decisions and what to expect from the economy as we move forward. It's great to have you, Arc Kola.
Thank you, Otto. Nice to be here.
And so, like you've heard, the outcome of the MPC meeting. First, let's look at the devaluation of the Naira. Was this the right time for this decision, considering the decline in our oil price, international oil price, and affecting the nation's revenue?
Yeah, thank you. I think I will look at this situation within the macroeconomic context in which Nigeria has found itself in the last 6 months to 12 months. There were clear indications, even before Sanusi left, that the situation with our economy is a little bit tight. First of all, we need to also appreciate the fact that this is a monoproduct economy with 70% of our revenues coming from oil.
But recently, the government has talked about the non-oil export revenue margins.
We'll get to that. Yeah, we're talking about what led to this. Where were we before now? Okay. So this is a monoproduct economy. Whether they are still trying to diversify or widen the base of the economy is another matter. So this is a monoproduct economy. A lot of things have been happening within the global economy, which we all know will definitely affect Nigeria. Let me remind you that in the last couple of months, the United States Federal Reserve has started the process of winding down on its quantitative easing, and that this essentially means that a lot of activities that are taking place in the capital markets in Africa and other emerging economies will have to take a kind of retreat. We are looking at a situation in which as they are bringing, and also the dollar itself has been weakened sufficiently. In fact, most of the major currencies of the world have been devalued one way or the other in the last 1 year or so. So, coupled with the fact that quantitative easing is gradually going down, and there is a lot of reduction in the activities in that direction. What that means immediately is that any emerging economy must begin to look at itself carefully, because the so-called yield hunt that was taking place in the emerging economy has to give way. So we see a situation in which our capital markets began to see gradual withdrawal of funds from that market. Yes, that's the first thing that happened. The second thing that happened as a result of that is the fact that once the dollar itself begin to have serious issues of devaluation, and a lot of conservative American economists were shouting against that, although they feel that that is the best thing for their economy at this time. So that also has an impact. So what we are trying to say now is that there have been gradual global economic developments that meant that eventually this will affect Nigeria. Oil itself, more discoveries were made. Shale oil was there. We talked about it all through the last year and in the last 7-8 months of the year. Also, we find a situation that oil is being discovered in more countries. There is also diversification of energy sources. What all that points to is that eventually the role of oil within the global economy will have to be reassessed. And what that means is that the price that we had for oil at the beginning of the year may not last long. Also, we knew about the arguments about what is the benchmark price for oil.
There was between
the National Assembly and the Federal Executive Council, and we saw a lot of dilly-dallying over that, which was really unnecessary, because they were looking at a situation whereby the budget is not unnecessarily optimistic based on some of these macroeconomic scenario that we were seeing. So it came to a head in the last 2 or 3 weeks when the price of oil precipitously dropped to under $80. And that is really what I called when you have a situation that was building up and eventually it got to a head, and then you had to do something. So Nigeria had to do something because the benchmark that we used for our
That's about 78.
yes, was about, and right now we are almost there. So there is no cushion, there is no cover. So then, of course, what are the issues that are facing the Nigerian economic managers? They had to do something about that immediately, because if nothing is done, then we see a situation where our budget, which is the best of times, we have not been faithful with the implementation of the budget. So now that you also have a situation where oil, which is the main driver of the budget, is already, the price is threatened, the volume is also threatened, matter of factly. So they needed to do something. And so we saw the finance minister and the Federal Executive Council coming up with what they call austerity measures. It will not be too long before we have monetary measures to back it up. So what they talk about, taxation, reduction in expenditure, widening the tax net, and of course, jacking up some of the rates, that are not too cyclical. So that we can have a more robust budget in the midst of the scarcity of funds. So immediately that happens. So those are some of the developments that preceded this Monetary Policy Committee meeting. And so, watchers of the economy are not too surprised. The question is, what time? Should they have taken that position before now? Or should they have waited for the fiscal? Or there is a kind of, they are working in tandem with each other. So I think no matter how you look at it, the Monetary Policy Committee needed to do something. And that they have done now. Because once you face this type of situation, the first thing that comes to your mind is devaluation. So that the little resources that you are getting, if we are selling 1 million barrels of oil for, let's say, for 80 million and $900 million dollars before, $100 million multiplied by 160 or 150 gives us something. But if you now have a situation where you have $80 million being realized, then you have to do something which will translate, because you want to strengthen the domestic economy. Yeah. Therefore, what do? When that happens, you have more naira. But the more naira you get in the circulation, it drives inflation up. So the next leg of it is to work on inflation, and that is to increase your monetary policy rate.
We'll come to that, because if you've looked at the inflation rate, it has been moving up almost 6 times now, and to almost 8.6%, and recently it's going down to like 8.4. So inflation is still a challenge, which some economists call it like a demon that should be tackled. The interest rate has moved from 12 to 13%.
Yeah, well,
what do you have to say to this particular
what they are trying to do, what the monetary authorities are trying to do is very simple and straightforward. What the impact would be on the economy itself, we'll look at later. But the important thing is that inflation has to be curtailed, because they have to defend. These are price stability and the defense of the naira. These are the core mandates of the Central Bank of Nigeria. So
for now they can't.
Yeah, but if they are not talking about, no, it's not as if they cannot defend. The naira's value is what is a joy to be in the overall interest of the economy. Yes. It does not mean that the value of your currency cannot fall. It may be able to fall within the rate. There is no need, if the economic fundamentals do not support the particular value of the naira at a particular time. Nothing says you cannot do something about it. Okay. But what we are saying is that you must be able to defend it. What is your reserve position? How many months imports can your reserve undertake? And once that is being depleted, there will be a lot of pressure on the basket of currencies that you have, which is called your reserve. If you cannot do 4 months or 5 months, or you've been doing 7 months and you are coming down to 4 months, based on some of these factors that we have highlighted before, in terms of the volume of inflow of your FX. Yeah. And in Nigeria's case, over 90% of that still continues to come from oil. And so we see what is going on, what is happening now. So devaluation is a devil's alternative. Of course, and then in order to checkmate or to curtail the impact of devaluation, interest rates have to move up to curtail the inflationary impact of devaluation. That's why that had to happen. But again, you need to look at it. That's why in economics, in managing the economy or in economics generally, you can't have it both ways. There's always this thing called trade-off. You know, you jack up this, you reduce that. If you have, like Philip Scoff used to say, you cannot have unemployment decrease without necessarily accompanying it with inflation rate and all that. So what they are trying to do right now is to be focused on containing inflation, which the central bank globally sees as, you know, the monetary authority's number one public enemy number one is inflation, because when inflation happens, a lot of other, you know, undesirable effects follow. So they need to curtail inflation, but then they need to do this devaluation thing almost immediately, and that they have done, and that is already happening in the market. You know, we have two markets. We have the parallel market, and we have, what is the justification for the existence of two markets? You will know that there is even a central bank position about that, so that they are trying to maintain some kind of level of difference. The differential, they will always tell you that they are trying to maintain the differential between the official market and the parallel market and all of that. So devaluation is a necessity at this time.